Okay, good evening, everyone. Uh, Welcome to the webinar series of CFA Society India. I'm Bhavin Gandhi. I am a part of Batliwala Karani Securities and Institutional Broker. I track oil and gas and transportation sectors. So today's session, which deals with oil, I think is probably very appropriately timed. We've seen wild fluctuations in the oil prices, with the oil coming down from $60 to sub $20. We've seen some of the international markers like WTI actually reporting a negative $37 in May future contract. And also, what has been equally intriguing probably is the geopolitics around oil. We had seen Saudi getting into an all-out price war in early March, and with the U.S. president's intervention, you had a resolution there, and OPEC plus Russia announced unprecedented production cuts of more than 10 million of about 10 million barrels per day. Uh, Obviously, this sharp volatility has had an impact on the oil industry. We have the oil majors, global oil majors reporting numbers, reporting sharp impairments and cutting back on dividends. We had the Indian bellwether stock, which reported earnings on Thursday, saw almost a 40% erosion in profits for the quarter. So if these questions relating to fundamentals of the oil market, the geopolitics of oil, probably the incentives of these global players, I think if these questions kind of intrigue you, probably you should have some answers today. Uh, uh, with that, I would like to welcome the speaker for the day, Mr. Kishore Narne. Kishore has been associated with Motilal Oswal Financial Securities. He heads the commodity and the currency desk at Motilal. He's been a recipient of several awards and accolades, and he's been a regular guest on business channels and has been a columnist on several newspapers. So I believe we have the right speaker to address the subject. Before we jump into the session, just a couple of housekeeping tips. Uh, the Q&A will last for about 30 minutes, and then we can start into a Q&A session. And also would request the participant to take the survey, which will be shared at the end of the chat and also in the confirmation. With that, I think I can hand over the session to Kishore. Kishore, you can start off.
Yeah, good evening. Thanks, Bhavin, for that, and thanks for giving me this opportunity to share views. I'll try to do some justice for your expectations. So, we all know that the kind of headlines we are witnessing in crude of late, and so there are a lot of questions and why a commodity which is actually has an intrinsic value has gone into negative pricing. How can it go and all those things? So a lot of things are going on. So before going into that, let's have a peek into the past. What I'll take you slightly into the past. Let's say last 100 years is something which we can look into. So crude has been volatile of late in the last 25, 30, 35 years. Before that, crude is not a commodity which sees that kind of price cycles, and it's been like the change which happened post 75 is that the cartelization of the entire production. Of course, we all know the story of Arab oil embargo, and which led to formation of OPEC and OPEC trying to control the prices, and the Arab world try to seize the prices in their control. And from there, the wider use of crude and its distillates and its derivatives in various industries actually has caused a significant price volatility. And also every time from there onward, from 80s onwards, typical geopolitics actually taken the center stage of anyone who actually tracks crude is actually tracking politics, not the economy, because economy doesn't really create that kind of what you call deviations in demand or even anything. So crude demand side, we are never worried about crude demand side, but it's always a supply side driven price discovery. So supply side is always impacted by political crisis anywhere or whatever it could happen on the supply side impacts prices. So that actually started to change as the shale became the center stage of oil, and gradually the base of control of oil over the last decade or so, especially if you see this last 10 years chart, uh, the only things which have caused upward move was Arab Spring, again sanctions on Iran. Again, that even these actually failed to push up the crude in a sustainable territory above that 90 to $100 territory. They have caused spikes, definitely, but not a sustainable rally from there. So again, failure of Libya has actually that's the last spike which we have seen in oil, and after that, as U.S. shale has taken the center stage post 2015 onwards, some that's where the control of base for oil prices have shifted from Middle East to U.S. Uh, and especially predominantly when you trade WTI, which is the US crude. So of course the premium between WTI and Brent also started to shift from there, because WTI became an oversupplied market, which is far away from the rest of the world. It takes much more. It's much more costlier to transport crude from that part of the world to either, let's say, Europe or Asia. So Brent is much more accessible through pipelines, through ground transport, through near port destinations and all. So WTI became a contract which is always oversupplied contract, and it actually started to pressurize overall oil markets. Then OPEC started to feel that it lost its control over the price, because the amount of production it can command has gone down, and it needed some reinforcements on its side. So it brought Russia together. So the classic OPEC Plus has formed from there somewhere in the middle of towards the end of 2016 or beginning of 2017, and they tried to push up the prices again in the vein. Actually, they're not able to sustain the prices upside as Trump hit on China. The global economy and its growth has been questioned by the trade war. So people started questioning the demand for crude and sustainability of on the demand front. And the latest is coronavirus. So let's get into that at much later stage. So this is the backdrop of crude, what's happened. Again, so as we go ahead, this is one chart actually. It explains itself. So when you look at crude, there is a very thin margin of difference between the demand and supply. So what we call is deficit or surplus. Uh, it's not high. So when whoever tracks crude, they understand the difference between demand and supply is hardly 500,000 barrels to 1,000,000 barrels. In extreme scenarios, it goes to 2 million barrels. So it's 0.5% to 1%. In the worst case, it goes up to 2%. That's the worst case which normally happens, right? So half a million barrels to 1 million barrels, either deficit or surplus. Uh, that's how the crude balance is occurs, because demand side is predictable. We all know how much the industry consumes, how much the automobile transportation sector consumes. So most of the things are predictable in nature on demand side. So supply actually uh, 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 tunes itself to match those demands. Whatever that excess or deficit is actually cushioned by the buffer stocks which we normally have. Every country, not every country, but most of the large countries, so all the OECD has strategic petroleum reserves. Uh, uh, Most of the developing countries nowadays have started creating reserves. So any deficit is met by the reserves. any surplus is again pumped into the reserves. So that's acts as a little bit of cushion in the market. So this is the demand supply balance in this market. We never see that huge amount of excess supply or huge amount of deficits coming up in the market. So which has actually, you can see post December 2019, as we started to enter this COVID-19 era or COVID-19 backdrop, we started to see abrupt and sudden lockdowns across the world, especially first starting from the air travel to industries to local transportation and personal transportation. So all these typically which consume crude or fossil fuels for that matter have been shut down. Either it is fuel oil to petroleum products to jet fuel, everything which comes out of crude has been shut down on as an instant basis. So which has created huge amount of surplus in the market, which came to around 10 million barrels in March. April numbers are yet to come, but we get the weekly numbers now. Currently we are sitting on 20-25 million barrels, and the latest numbers are 35 million barrels per day is the excess supply in the market. So as we have seen, the extreme price movement actually can be seen in the unanticipated or unimaginable kind of surplus per day. So 35 million barrels of crude has to go into inventory every day because that's not getting consumed. So typically you can see that typically we produce roughly around 100, 102, 105 million barrels per day. We roughly consume that much itself, and any price advantage which normally stockists get the advantage of that. So this is typically again the production between the OECD countries, China, former Soviet Union, the CIS nations, and other non-OECD, and the OPEC. So what you can see here is the OPEC and OECD are more or less same now, and OECD is predominantly dominated by US. So the supply side, which was supposed to, the OECD was always the consuming side, and OPEC was always the producing side. Now OECD has actually started dominating this market. The rest of all markets you can see now, other than OECD, is almost fattish. There is a marginal improvement on the Russian front. Otherwise, the production has been pretty much stable. The only thing is the balance have shifted in the power. So we can see in this, where actually the OPEC, even in this last year or so, this is last 1 year numbers, has actually continuously started losing its market share. So which started with around 35%, now stands at 32% contribution of the world production. So OPEC is constantly losing its footing in the oil market, where it was supposed to control the large amount of oil. Today it's a secondary producer as far as, so that's where it required the support of Russia. So as we all know that Saudi is the kingpin which controls the entire OPEC, which is supposed to be the largest producer in the world, has now become not even second, the third largest producer. It still is the large exporter of crude, because US, whatever the large production which it makes, it consumes itself. So if you go to the export market, you still find Saudi as the large exporter. But US is the largest producer in the world today. This is the current production numbers. They went up to more than 13 million barrels also on the higher side. Currently, they are close to around slightly under 13 million barrels. Saudi can produce 12 million barrels. Right now, they are pumping up around slightly high, about 10. Russia is close to around 11. So then comes the smaller ones, Iran, Iraq, which are anyway disturbed nations. Canada is expensive. Brazil, Mexico, and all these smaller nations comes into play. And you go to the rest of the OPEC, like Venezuela, Libya, and all Syria kind of things. They're very tiny in nature, and they don't really have any price control. So they just have to follow the footsteps of Saudi, and Saudi normally tries to exploit them. But you can understand, if Saudi didn't had Russia as its partner, it can't decide or it can't dictate its terms on the crude market. So that's where it needed to have this support from Russia, and which has been achieved. 2 years back, roughly, Saudi, OPEC and Russia came together to help each other and maintain the price stability in the market. They actually want to push up, they put it as price stability, but they want to push up the markets. But they least expected that the sharp increase of US oil will take away their market share. So now they're struggling with, can I sacrifice market share or should I sacrifice the price? So that's the struggle which they are going. And of late, actually, the phenomenon which we have seen is the negative pricing. So just to put it in perspective, so basically what buyer is saying is that seller, sell your crude and keep the money too. So basically what you're saying is, keep your crude with you, I'll pay the money. So that's what has happened in negative pricing. So the people who had long positions, basically they are the buyers in the market. So when they have to exit the market, they become sellers, right? So to square off their positions, they will become a seller in the market. So the buyer on the other side, who is holding the crude, belongs to the seller. He's actually asking a question that what to do with the crude. So the seller actually doesn't want the possession of crude. So people are giving you crude and over and above money to keep that crude. So that's something which is absurd in any market, for that matter, for any asset class, for any market. But here, the circumstances which led to that are technical. I don't say they're fundamental, but they're technical in nature. They have been going on for many years. Suddenly there is a question on that, but the contract has been like that for many years. So just to give you a perspective, a lot of people might not be aware of the deliveries of commodities. So I just put a couple of slides to explain how and the fundamental structure of deliveries work. All the commodities work in delivery settlement. So they are settled by delivery. In India, it's mandatory for all the commodities, excluding the energy commodities, both the natural gas and crude. These two are prohibited by the government of India, that none other than the OMCs and ONGC and some of the importers and refiners, so no other private individuals can hold both energy products like crude and natural gas. So apart from these two, rest of all commodities are mandatorily delivery settled. So how it works is, when seller has to, when the delivery time comes, so seller can sell the goods at any point of time, whatever the time he wishes, whenever the price he likes it. So he sold it, but before the delivery, when the delivery period starts, before the delivery, the seller has to go to the exchange warehouse and deposit his commodity into the warehouse, and the warehouse gets a sample, or it checks the documentation and it verifies and it certifies that this is the goods which are in sync with the contract specifications, and they match the specifications of required exchange, and they confirm the quantity and quality of the goods and send an intimation to the Commerce, that's the demat which operates demat facilities in MCX. So they send the WSP is the warehouse service provider, sends an intimation to the demat. So the depositor will get a demat credit in his account. So on delivery, he actually gives his demat credit, transfers the DP transfers the demat credit to the buyer, and he gets the money, and how it settles. So the guy who got delivery, he can actually go to the warehouse and again rematerialize the receipt which he got, the electronic credit he got, and take the physical possession of goods and take the delivery to his warehouse or to his factory or wherever he wants to. This is the structure and this is how it works. So absolutely there is no chance that a seller can deliver goods if there is no space in the warehouse. So the first and priority of the seller is, when he is going to deliver, he has to ensure that there is space for me to put my goods. If I can't, though I have goods with me, which are qualified or which are suitable to the contract specifications of the exchange, but still if I'm not able to put that into the exchange warehouse and get my electronic credit, I will not be able to meet the delivery requirements. So he will be defaulting on the delivery thing. But if you go to the Brent, like the other contract, how it functions in Brent, why Brent didn't go to negative. So Brent, actually, if you see the contract specifications, how the delivery settlement happens in Brent is, uh, uh, on the expiry day, the delivery happens through EFP. EFP is something called exchange for physicals. So exchange for physicals is that where the contract, the buyer and seller goes off the market. Both the contracts are removed from the open interest, and both they go to the private, the off market, and both exchange delivery, and both confirm to the exchange my delivery is satisfactory and I am done. So once that confirmation comes, that open interest is removed from the exchange OI. So this is called exchange for physical. So you can actually convert your derivative positions into physical positions and settle your derivatives through delivery with both of the buyer and seller satisfaction. So in that case, the physical delivery is settled because both of you are agreeing, the buyer and seller is agreeing, so exchange has no problem in that. And those people who are not able to do that, they have the option to cash settle the contract on the ICE Brent index price. So they publish the ICE Brent index price. On that price, they can do a cash settle of the contract. So when you have the cash settle option, and even though you have any issue on the storage space, etc., so you will not be, still the value of the commodity will never go into negative. That is because both seller and buyer will at least agree on zero, and there's no other way of doing it. But when you go to the WTI futures, the WTI is a very different contract. So if you read this few things, the WTI says that whenever you have to deliver a commodity, delivery will be made free on board at any pipeline or storage facility in Cushing, Oklahoma, with pipeline access to Enterprise, Cushing storage, or Enbridge or Cushing storage. So what happens is, delivery shall be made. It's not made yet. At the delivery time, when the buyer says that you can ask for delivery, the buyer can ask for delivery in any pipeline or storage facility in Cushing with pipeline access to Enterprise, Cushing storage, or Enbridge and Cushing storage. So there are two different pipelines which goes through. Cushing itself is a big oil pipeline hub. It's like a large railway junction where many railway lines come crisscross, and they actually change routes and all those things. So that works like a junction box in crude delivery, and large amount of crude. I think more than 90% of crude in US is transported and delivered through pipelines. They have a vast amount of pipeline network, and the delivery on WTI crude clearly says that once the settlement has, once the delivery expiry happens, the buyer has to choose, and the delivery shall be made in any of the following methods. One is, either the seller will pump over into your designated pipeline, you tell me which pipeline I should be giving you delivery, or you show me a storage facility where you want me to send the goods, but that storage facility has to be connected with either either with the enterprise storage, the enterprise pipeline, or the Enbridge. So any of these two pipelines, it should be connected. That's the condition. On that, seller will deliver. So it's the responsibility of the buyer to show where to deliver. That's the critical technical point which none of the other contracts has. And if seller agrees to deliver at any of these facilities which is used by the seller, or allow such transfer without physical movement of product. For example, if the seller has a tank or crude oil in a tank in Cushing already, and he just gives you a ownership transfer, even that is still fine. So you can be considering that as a delivery. But in this case, the crude is already present in a warehouse in a tank, so there is no problem of space. In both the above conditions, the space constraints comes into play. So I'll just show you a little bit about Cushing. So Cushing is a place, it's called the pipeline crossroads of the world. So this is a major pipeline junction. So I'll show you how simple or how complicated the Cushing storage facilities are. So I'll just show you some of the pictures. So this is the Cushing, Oklahoma storage facilities. These are all the oil tanks. The green lines are the pipelines which connect them. So you can actually see the owners who operate these pipelines, who are the companies which own them, and where it connects, and all those things. Basically, these are the pipelines which actually comes to this the storage fields of the Cushing. This is a place. So I just zoom out a little bit. So that's the what you call the entire picture which I have shown you earlier was this much, and this is the entire Oklahoma, entire state you can see here in this picture. So if you go a little bit zoom out further, you can see the entire United States with all the pipelines. This is all the gas pipelines laid across the United States from the all the way from Alaska to down the Gulf of Mexico. So wherever the crude has to be transported, wherever it is produced. So and even it's connected to Canada and some of the other oil fields. So and the West Coast and East Coast, say everywhere. So critically, the Oklahoma and Cushing becomes a major junction point where the crude can be transported to the north, to the east, to the west, or to the south. That gives Cushing a very strategic advantage, and it's large facility. They also have some other what you call the hubs or where the junctions are there, but Cushing is the biggest because Cushing gives you access to all the directions. So that's the importance of Cushing, and that's where the delivery center for WTI crude, which says that a buyer has to show the seller where to deliver. So as of now, when I see that I have a position which is short in the market, and I go when I have to cover it back. So I go and cover it back. So when I cover, I have to be a buyer. So as a buyer, I have to get crude. So what happens is the seller in an oversupplied market, he wants to, at any cost, he wants to leave his crude and give delivery. As a buyer, I try to avoid delivery and see that I don't get crude, because there is no, absolutely the entire pipelines are packed. The entire storage is packed. If you just go 4 to 5 weeks back, let's say towards February, end of February, I can say end of February, the entire Cushing facility was full by around 48%. It was like 52% was still empty. And today, if we talk today, it is 78% is full. And the rest of the storage of around around 20-22% also, the pipelines keep moving. So you cannot actually fill it to the 100% because the crude is actually getting transported to this refinery, to that. It works like an electricity grid. So it's a so you cannot actually stuff it 100% because then you will not be able to move crude from one place to the other place. So it's almost full to the brim. So that actually caused buyers to say that, yeah, I don't have a place to store it. You keep your crude. I want to square off my positions. So in that case, the buyer kept on putting orders at lower and lower and lower prices, where at the end he was able to push the prices down to minus $40. So the low on that day was minus $40, though it settled at minus 37 something. So the low was $40. So what it means is, as a seller, so the buyer who was a buyer has become a seller because he has to square off his transaction. So he's saying that you keep your crude and I pay you another 37%, another $37 to keeping your crude. Don't give me. As a buyer, I'm telling the seller, you keep your crude, I'll give you another $37. That's how the settlement happened. And so that's how the negative pricing of an asset came. Though at the same time, on the same day, at the same time, though the Brent was still trading at $25 roughly positive. And even on the other hubs within the US also, the physical market was still trading in positive. The only NYMEX contract on that day went into negative, and by the next day when the settlement happened and the next expiry opened, again we were back to $10 positive. So that's the story of negative pricing and how it came. Can it come again? Yes, no, not a really big question, because at this point of time, this is the amount of change of inventories in Cushing port, the Cushing hub. So you can see that though there is a little bit of fall in the increments. So this is not the absolute amounts. This is the rate of change, I can say. So the amount of total fillings have come down, but still it's getting filled almost like 3 million barrels a day. So if it gets filled in this manner, in the next 15 days we will not have any space there. That's the kind of speed which is right now which is happening in Cushing. So I'll give the entire US storage. This is not Cushing only. This is the entire US weekly stocks of crude and petroleum products. You can see the all-time high was more than 2 million barrels. Today, it's close to around 2.01 million barrels. So we have seen this coming in somewhere in 2016, and which happened again in 2020. But still, the problem here is the other smaller facilities everywhere are shut. So there is no other place to keep the goods. This is one way of looking at it. Again, this is the crude price versus the Cushing, Oklahoma inventory. The orange line is the crude price, and the blue line is the Oklahoma, the Cushing storage facility. So it right now has roughly around 63 million barrels of crude, and you can actually see the absolute fall which has happened of late has exactly inverted to with the Cushing storage. So you can say that there are some places where this kind of thing didn't happen. So this is the fall which has happened post Lehman crisis, the subprime crisis fall. This is again after the European crisis, when the crude started to fall and inventory started to jump higher and higher. So this is what happening, and this was a trade war related fall which we have seen. So apart from these two, where the inventory-led fall, the demand-led concerns have happened in these two instances. This is the sharpest increase ever has happened, which has caused the sharpest price fall ever we have seen in the history of any market for that matter. So this is the total storage and the capacity by again region-wise. You can see not only US, China is almost full, Northeast Asia is full. We can see the entire world. If you even see that, the rest of the world also, there is that smaller countries will still have some capacities. India has some capacity. For example, we have some spare capacity where we can fill it up. Middle East again is full. Mediterranean coast is full, South America is full because Brazil and Brazil has been filling up its inventories. So absolutely across the world, if we go and continue these lockdowns for next 3-4 weeks, you'll have to cut the production. There's no other way. So right now we might be hearing that from May 1st onwards, OPEC is cutting production by 10 million barrels, but the amount of demand destruction which happened is so significant that right now we have 35 million barrels of surplus crude coming out every day. And this is one matrix or one indicator which we closely follow and closely watch. This is the OECD commercial inventories, all the OECD nations commercial inventories. And this is not inventory in million barrels or any of these things, but this is in the number of days it can sustain. So the number of days of supply. So which is currently reached around 84 days. At this point of time, the OECD countries are holding their 84 days consumption worth of crude in their inventories. And this is the EIA data anyway, and EIA is bound to be bullish on crude always, and but anyway, they still predict that we will be slowly going down. But one thing which you can really see is how much time it takes to clear out this glut. The glut cannot be immediately cleared out. It's extremely difficult, even if the lockdowns open, let's say at the end of May or at the end of June. It will take at least 3 to 4 months to clear the initial glut, because I think it's not a big, you don't need to have a lot of thought process to understand that the aviation industry is not going to jumpstart immediately, right? It will take some time for the people to fly, especially the long haul flights will take much more time. Maybe people will still be comfortable with the short haul flights. People will not be spending too much on large, the automobile demand might be still slow. To clear off this glut itself, it will take a lot of time and a lot of growth to restore. So even the normalcy will take a long time to come. And so one of the stories which is still has space is the US strategic petroleum reserves. But what happened is earlier Trump said that he'll be filling SPR, but unfortunately in the package which we announced, he didn't sanction any money for this. So of course, every country, even India today, has the storage capacity, but whether do they have money to buy extra crude and keep it? Again, I'm not sure. Government would be trying to save as much money as possible to revive the economy rather than hoarding or storing crude. So similarly, in some places where the storage is available, people don't want to just buy and sit on crude. And one more question which before deciding what is going to happen. So there is some discussion which is going on, is that are we entering the end game for crude? End game for crude is, I think in the next decade, will the fossil fuels or the crude itself will have this kind of importance or not? Will this still be dominating the energy requirements? Yes, I think for that matter, it's still yes, but I think we are having a major shift which is happening. So when we are seeing that we have already peaked out in demand and we are going to have a declining demand picture, then it's about the game changes from price to market share. So everyone wants to push as much crude as possible and they want to grab as much market share as possible. I think that's one shift which is happening in crude, and I don't think there will be any more cartelizations, and especially the West and Middle East and Russia can sit together and do cartelization. I have my doubts on that. There will be huge amount of behavioral changes on the consumer front that could accelerate the peak demand theory of fossil fuels. Again, ESG is again a big thing when you are looking for capital. I think the people who are actually using large amount of fossil fuels and polluting the world are not getting uh, 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 honored or not getting invested by the funds. So, and I think the large companies like BP, Shell has already told that they will be shifting away from fossil fuels and they'll be going to renewables very soon. So the entire the picture is changing there. It will take time. I'm not saying that overnight it will change. It will take time. Uh, if you see before this, these are the numbers before this. These are the headlines which you can see before, let's say, November or September of last year. Most of the European countries started to target 2030 as a year where they don't want any internal combustion engine cars or any gasoline cars or any diesel cars for that matter. So these are timelines many of the European countries have set for themselves. Even countries like Asian countries, Spain, North Korea, sorry, South Korea, India, Denmark, all of these people have come together saying that they will be at least having a net zero emission mandate by 2050. So are we going in that direction, or the crude price might kill this EV boom? The debate is still on. Uh, but I think even at $45-50, EV is still viable, but at maybe $20-25, EV might not be viable. So it might delay that, but I don't think that it will change the course of the direction. So what is actually a comfortable price? So this is the large producer. Of course, the US is the largest producer. So when we look at US shale producers by region, by each basin which we have there, so these are the break-even prices of those, the cost of production of break-even prices. So at $40, most of the shale oil is profitable and they'll be comfortable in producing. Even at 35, I believe that with as necessity is the mother of innovation. Today, they will continue to explore more technology, how to reduce the cost and all. I think they will tighten their belts, might be bringing this down to 35 also. So I believe that 35-40 is a very comfortable price for shale producers. But you come to the Middle East, so in OPEC, we don't see cost of production. So what we see is the budgeted price for crude. So if they have to balance their fiscal deficits or the budgets of their respective countries, what is the price it is needed? So of course, Saudi has the highest amount of spending, and so they need at least $80 per barrel to balance their budget. But on the other spectrum, Russia has the necessity for $40 price. So I think at $40, everyone in the OPEC also will be comfortable. So when we see shale is comfortable at 40, OPEC will be comfortable at 40. I think consumers also will be comfortable at 40. It will keep the fire in EV. I think that's the normal, the new normal for crude post-COVID could still be that 40 will be the new 80 kind of thing. So earlier it was 80, now it's come down to 40. So what we look at is currently the market is oversupplied by 35 million barrels approximately. I expect June to come down to around 10 to 12 million barrels oversupply, but still it will be oversupplied. May 1st onwards, the OPEC Plus is going to cut another 10 million barrels per day. They have just started in the couple of days, but the implementation will take another 15-20 days to actually come to see the numbers. But at this point of time, because of the logistical constraints, we are not getting numbers as accurately as possible through either Reuters or Bloomberg's. But I think they will be cutting anyway because they don't have any place to put this crude. And so, but despite all these things, we expect the prices to still remain under severe pressure. May and June expiries also will be going somewhere between $4 to $7 per barrel. And as even the economy start to reopen, it will take at least 2 to 3 months to normalize and reduce a little bit of glut which was built there from almost $90 consumption, which is in the inventories of OECD, to bring down that to the 70 itself. It will take 3 months. So that will keep the pressure on. And so at least mid-August or September is something which we are looking at, that to some of the glut could clear off, and there will be some balance because the production cuts will take place. At the same time, some of the demand could recover. Uh, but again, post-COVID, how much time it will take? Again, I don't have any idea about that. How much time it will take for the world to recover from COVID crisis, and how the economy will restore itself, I don't know. But whenever it restores, my outlook for crude in a normalcy, once the economy restores, is still be around $35 to $45. So 40 will be the average. Price will move $5 here and there. I think that's where the trading range for crude post-COVID scenario will be. So that's it from me. You can start any questions, Bhavin.
Great, Kishore. I think that was a very exhaustive presentation. We can take the Q&A. I just wanted to start off with a question that I had in mind. Is if you can just talk a little bit on the incentives of these players. So whether Russia's incentives are different from Saudi's incentives, and whether Saudi's incentives are different from what US intentions are. So if you can talk a little bit on that part.
Yeah, so I think the geopolitics, I intentionally left it out, and because it takes another an hour once you enter that territory. So I think, see, Russia has been anticipating this move that they will be betraying OPEC and will trigger a price war. I think Putin knows that very well, and he has been preparing for that. One thing which I can see is that they have been building assets in some of the Russian oil companies. They have been buying gold aggressively. Last year, when I see central bank purchases, Russia has been the largest buyer in gold, as far as reserves are concerned. Because of course they have two issues. One is that they want to, because of the sanctions, they want to deviate from dollars in the forex reserves, and they want to have something like gold, which can be exchanged as a barter if needed, and if something triggers, because that's his preparation, like the Cold War kind of mindset which he has. But I think his intention is very clear: break the U.S. backbone of crude, because that's what the Trump will be basing to get himself re-elected. Because once the crude crash happens, Trump is the guy who will be the having biggest challenge. So Trump will come onto the table to discuss things with Russia and Saudi. So then Russia will put on the table that you ease my sanctions, I'll cooperate with you. I think they are using crude as a weapon against Trump, just to put pressure, that so that he can come and ease some of the sanctions, because this year they lost around 1.5% of GDP to sanctions. And second is, they are not the biggest oil exporters anyway. They are the biggest gas exporters, and the pipeline which they have, pipeline supplies to Europe, has been impacted by the sanctions. The construction of a pipeline as well as the distribution of gas. So what he will be asking is that you relax my sanctions on the gas pipeline, I'll cooperate with you on the crude. I think that's his idea. Saudi, of course, has the market share, is his intention. He wants to grab as much as market share. And if Russia doesn't support, he is open for the war, kind of thing, the price war. I'm not saying the actual war. And US is the elections is the something which Trump is looking for.
So Kishore, there have been a lot of questions being asked on the impact of storage of oil, and how this will pan out, and what the impact do you see on crude oil because of the storage costs.
Yeah, see, whenever you crude, electricity, any energy for that matter, natural gas, these are very different commodities, because you need a specific infrastructure to store these commodities. And electricity, of course, you cannot even store that. So energy is something, if you produce, you have to consume. There's no intermediary, is very small, especially in electricity. If everyone switches off the lights now, the generators have to be stopped. There's no other way. You have to, the immediate repercussions happen, right? The grid will fail. In crude and natural gas, of course, you have a little bit of storage space, And looking at that, if there is too much of supply in the market, so whoever has this additional space to be let out, he'll be charging more and more. So you can see just in the last 2 months, the charges for VLCCs, the very large crude containers, have more than doubled. Now they are charging roughly around 180,000 euros kind of thing, or $210,000 per day per VLCC. And just to be anchored, it's not even moving, it's just to be anchored. So anchoring charges itself is that much. So on ground storage is very difficult to obtain, and that to the storage which is connected to a pipeline is extremely expensive right now. So when you see last time when crude went to $25, 20, 24, $25, when Lehman crisis happened, and then during the European crisis also, actually, PIGS crisis when it happened. So whenever it goes to that, that means there is a glut. So whenever a commodity is into glut, you can see the contango rises significantly. The contango is the difference between the near month and the far month. So when crude went to 24 in the European crisis time, 2000, I think 12, 13 or 14, I don't remember that, but the contango per month was 8 to 9%. So we get a lot of calls at that point of time that everyone wants to buy crude. So I keep on explaining that you can't make money in crude because the carry cost of a futures derivative contract in a year is 96%. Even if the crude doubles from here, you will not make money. So similarly, right now, the difference between the near month and far month has gone to 50% a month also. So that's what the storage cost does to crude.
The other question that I see here is the impact or the practical implications of shutting production. So if you can comment on that, how easy is that, and can that production kind of come back?
Yeah. So you go to the traditional wells like Middle East or some of the Mediterranean countries like Azerbaijan or any of these countries, the old traditional wells. You can just shut it off. It's not really that big deal. It's like turning on a motor and turning off a motor kind of thing. So these are reservoirs of crude which are there. You are actually drilling into that. But the shale is completely a different story because you are doing a large amount of fracking. So a large amount of stone or a kind of a coal has been broken into fractures, and the entire earth in that area has been fractured, and you actually tries to collect the small droplets of crude which has been trapped into this small volcanic soil or rock, and try to drill many holes in the same area to collect small amount of oil. That's the difference between extracting oil from a reservoir and extracting a shale oil. So whenever you stop pumping of shale, you lose pressure in that well. So the moment you shut down a well, to reopen, you have to actually do a fracking again. You have to frack it again. So when you do fracking, it's the capital cost. So today, with this kind of balance sheet which they are sitting already, they have a hugely leveraged balance sheets. So U.S. shale oil producers will not be able to reopen if they shut down. So right now, even despite having losses, despite having negative pricing, people are still producing crude, because today, why should we have 35 million barrels of surplus output when we know that nobody is consuming? I should be actually switching off the pump. So it's not that easy. That's why the production is still going on and we are struggling to store it. So the pressure in the oil well is extremely crucial. If the pressure drops beyond a certain point, then you have to drill it again, you have to frack it again, especially in shale, and it's a capital intensive, and already these people are too much on borrowed capital, and it becomes almost like almost like bankruptcy kind of situation for most of these oil wells.
Sure. Great. The other question that we had is implications of these high storage costs for India, given they have limited storage capacity. So if you can comment on that part.
Yeah, so idea is that it's easier to store underground rather than above the ground. So don't buy crude. It's as simple as that. Because if you buy crude, yeah, you are able to buy crude at $4, but you have to store it at $30. So you eventually are anyway buying at $35. So let Dubai or let Oman or any of these our trading partners, Iran, let them store, because the underground storage, until unless you are not extracting the oil from reservoir, it is that's the free cost, that's the free storage available. So we have a little bit of storage capacity in our Mangalore hub. We have strategic petroleum reserves which the government of India has created. But actually, they have rented some of the space to Dubai. Even in that, last time when it went to $24, Dubai paid us $13 per barrel to keep the oil there. So some of the space belongs to them, but I think still the problem is the only country which is buying and storing crude at zero or this kind of almost close to zero prices is China. There's no other country which is buying at this point of time for storage purposes. They are storing. US of course has to store. It's a private storage. It's not the government storage. Europe has a large amount of storage facilities, but they already are full mostly. And the emerging nations like Philippines, Manila, the Philippines, Indonesia, some of the African countries have storage facilities, but they are not. I don't think they are actually buying crude. They are normally renting out their storage space rather than buying crude.
There is one technical question where the participant is asking where that MCX uses WTI for crude futures, whereas India predominantly uses Brent. So could you explain the reasons for that?
So MCX has nothing to do with what India wants. MCX is an exchange which was 90% of what happens on MCX is speculative, right? At the exchange level, I'm not talking about the commodity level. I'm talking about all commodities included, all the entire volumes included. It is 90% is speculative, 10% is hedges. So, and within that 90%, 45% is arbitrage volumes. Arbitrage between NYMEX in India, arbitrage between DGCX in India. So basically, these, if you go by even crude, 45% is a published data by MCX, that is a algo volume. So algo is nothing but arbitrage. Though the leg of the on foreign leg is illegal in India. So these people normally create two different entities. One is a foreign entity which is trading in Dubai. The one is the Indian entity. So they trade that basically. So WTI becomes much more easier to trade an arbitrage trade. So initially when FT created this exchange, predominantly they targeted these players to give that initial volume supports which they needed. So WTI became a benchmark, and we never had any problem because anyway ours is a cash settled contract and we are just taking that price. This is an extraordinary situation which we have entered into. MCX could have done better to manage the situation, or the SEBI could have done better. That's a very different place to go. But now everyone starts to question that. So to be very frank, in crude, absolutely 100% is speculative in India. There are no hedges. None of the airlines, none of the OMCs, not even ONGC, none of these players are on the market.
The other question is if you can provide some perspective on the breakup of crude demand amongst different sectors, for example, oil,
Of
transportation,
course, the
etc.
biggest sector is the personal automobile, personal movement space, the automobiles. Number one. Number two is the aviation fuel. Number three is the fuel oil. And then there are hundreds of derivatives into that, like from plastics to polymers to specialty chemicals to butane, all these benzene kind of things. But there are hundreds of them. So derivatives are many, but predominantly it is petrol, that's the gasoline, and distillates, that's the diesel. So then within the automobile space, you'll come into the personal transportation versus public transportation versus railways, shipping, right? So everything. So the movement as a fuel of moving a ship or moving a car or moving a bus or moving a train or moving a flight. I think these are the things which dominates. So I can say around 62% goes into the automobiles as fuel.
The other question that one of the participants was asking is if China was to remove dollar as a medium of exchange, will it have any implications for the oil markets?
Not really. I think it's not the question whether China has the power to do that or not. So currencies are something that has to be trusted and accepted by people. So if dollar has to be removed as a reserve currency or a tradable trade currency, that's predominantly the advantage of dollar is that it is accepted everywhere and nobody questions it, and everyone has a trust in US economy that it will not let dollar to suddenly collapse or suddenly this thing. So people, when they want to hold their purchasing power in a particular currency, they have to trust that currency. So I believe that it is extremely difficult to replace dollar as that world currency, and China doesn't have that kind of power anyway. Um, so it's a little bit of hypothetical question, but people are actually looking at cryptocurrencies. People are looking at uh, people will still accept crypto, but not renminbi as a currency.
Right. I think we've done with most of the questions. There's one question which is kind of asking, the participant is asking if the COVID impact is more extended. Can you see bankruptcies happening in US, and whether US can come in and bail some of them out?
Of course, I think from the end of, see, even before COVID, the personal bankruptcies in US have been increasing. I think if you go through an article which was an Economist, I think 2 weeks back, the personal bankruptcies have been on the almost like a all-time high in US. So US economy was doing well or not, stock markets were doing well, everyone was rosy before COVID, but trade war was the only threat everyone was looking at. But I think there will be massive amounts of bankruptcies which will be in every country, not only in US, in every country. There'll be rebuilding of many of the industries. There'll be re-engineering the models of businesses, which has to be done, how the business models will function. Again, one of the point which I mentioned is there will be a massive change in behavior of consumer, how they will spend their money from here onwards, what will become essential, what will become non-essential, and anything, some kind of this episode when it passes by, uh, the people who were spending earlier now starts to save. As Bhavin, that keep saving rather than spending actually creates enormous amount of stress on demand. So the moment people start to save, because today we don't have any guarantee that the second wave of COVID will not hit us. Let's say we are opening from the lockdowns, there is no guarantee that second wave will not hit. And it's not like 99% of the world has gone through COVID and whoever has died, whoever rest of the people have survived. That's not as simple as that. Hardly maybe 5% of the world population has got impacted, but 95% are in the scare of getting impacted. Once it is impacted, we are still okay, but 95% of the people are in the scare of getting impacted. And I don't think vaccine is an answer. Vaccine cannot bring back the economy. Vaccine, once everyone is vaccinated, it's a different issue. So to get everyone vaccinated is a big problem which we have. If the cure comes, that a particular tablet, if you take this medicine, you will be cured of COVID, don't worry about that. Then you and me will be able to go out of the house and go and work freely, because now I'm no more scared about COVID. So even I get COVID, it's like I'm getting malaria. I'll go to the doctor. I have a medicine. I'll eat it. I am fine. But until unless that cure comes, till you are getting vaccinated yourself, you are still having that fear of boarding a flight, of going into a school or going into an office. You'll still have that fear. So my idea is that probably we will not get back to normalcy maybe within next 12 to 14 months or even 18 months, despite a vaccine might be invented and it could be manufactured, but it will take a long time for everyone in the world to get vaccinated.
Great. There's one more question that participant had. Given your views on oil, So what are you recommending to your investors? Any particular sectors that you kind of are recommending, or how do you play the view that you have?
So I'm not an equity analyst to suggest sectors and all those things, but on commodities, we have been very clear in media that we are saying that those people who want to speculate in crude to stay away from crude. It's not the time to trade crude. Even the experts are failing considerably every day in, day out. And it's again very difficult to say, because crude price crash can be a boon to some of the industries, but at the same time, can they get this advantage into their P&L is a big question, because if the top line sales is not going to happen, whether the cost advantage will benefit them or not is a big question. Second is, when we are looking at, we are seeing that one is that affordability of an owning and running an automobile has become significantly lower right now, right? So once we back into the in a normal mode, let's say lockdowns open, your rate of loan or of borrowing money has come down, so you'll be able to easily afford a loan on a car than earlier, and running a car becomes cheaper. Unlike India, I'm not talking about India, but if you are in US, the ownership of an automobile has become extremely cheap, because now you're getting at a 0% interest rate loans, plus your fuel costs have come down rapidly. So your ability to own and operate an automobile is lower. So that means the people will go and rush and buy automobiles or not. I'm not sure of that. In India, it's a different story, because the government will not allow you to get the benefit of the lower cost of crude as a consumer, because government will take that difference. They will not let that to be passed on to the consumers. So as an industry, for example, the industry which will benefit from highest benefit will happen into the aviation industry, right? But are they able to take the benefit of that? No. So it's extremely
Right.
difficult to trade this
Right.
in the perspective that which sectors to pick up.
Sure, sure. I think that sums up. I think that we don't have any more questions. I think that was a fantastic presentation. Thanks, Kishore. I think oil is an extremely complex subject, so I think it was a very lucid presentation from your end. Thank
Thank
you
you.
so much. And I urge the participants to take the survey link and give us the feedback. That's very important for us. And also, the presentation will be shared tomorrow. So till then, stay safe. Thank you very much.